Hello everyone and welcome to this week's FX update. My name's Craig Erlam, Senior Market Analyst at OANDA. I hope you've all had a fantastic weekend and everything is going well. Thank you as ever for joining us for this week's webinar. As ever again, if you've got any questions or anything, please don't hesitate to ask and we'll try to answer any questions you have probably towards the end, if I'm honest, as opposed to during, but if the questions are relevant to what I'm talking about, I will try and expand upon it. What you should see in front of you right now is the OANDA MarketPulse website. That's where you'll find all of our daily content written by myself and my fellow analysts around the world. It's also where you'll later on find the recording of this webinar, which should be up in a few hours' time. So please do check it out if you want to revert back to anything or double check anything. And as ever, you can always reach out to me on Twitter and ask me any questions. My Twitter handle is Craig_Forex. Also on the website, you will find the economic calendar, and that can be found just here. Now, I've opened that up on a separate tab because I have narrowed down the economic calendar just to cover the particular relevant countries for the currencies which we're covering today. So just to save a little bit of time. And it is a bit of a relatively data-heavy week, if I'm honest. And we've had a couple of these. It's usually the third week of the month where it does go a little bit light on the economic data side, particularly when we're talking Europe and the US. But it has been interesting nonetheless. Now, for those of you who aren't in the UK, you may not obviously have as much interest in what's happening here as I do and others in the region do. But we are very much seeing a lot of attention right now. Some would argue for the right reasons, some would argue otherwise. The data would suggest the otherwise, though. We are now approaching the day when we will exit the European Union, assuming we don't hit any last-minute surprises. And to be honest, last-minute surprises is not something I'd necessarily write off, although it's very much not my base case scenario. But as we do get closer and the uncertainty remains, or the fog, as Mark Carney and the Bank of England repeatedly referred to it as, the data is certainly suffering. And we've seen this in the recent GDP data. The 1.3% economic growth year on year in the fourth quarter, the slowest rate of growth since 2012. We saw business investment, which hasn't shown up on this data because I have narrowed it down to medium and high tier data. When you drill down into the data, business investment fell by, I think, 4.7% in the fourth quarter. And I don't think the first quarter of this year is going to be any better. Quarterly growth remained in growth territory. So we avoided a contraction. The risk of a recession just before we leave has receded, although these numbers are subject to revision. But big drop in manufacturing production, surely related to the Brexit uncertainty once again. Monthly GDP in December, a contraction 0.4% compared to a month earlier. I wonder how much of that, to be honest, has to do with people doing their Christmas shopping that little bit earlier. Black Friday, of course, which now really is more of a week-long event rather than a one-day event, attracting far more attention for the sales than the pre- and post-Christmas period nowadays. So I wonder how much of that had to do with it. But we also did see general consumer spending actually reduce in the run-up to Christmas. And a lot of this, again, was being attributed to Brexit uncertainty about job prospects, and therefore that little bit of more conservatism amongst UK consumers. So clearly massively taking its toll on the data there, and we saw that take its toll again on the pound, although not in an extreme way, but we certainly saw a response here. As the week goes on, we will have more economic data coming from the UK. We also will hear from Theresa May, and she's actually speaking as I speak now. Unfortunately, I don't have it on in the background, so I can't provide live updates, but she is addressing Parliament as we speak with regards to the meeting on Thursday, or the sitting in Parliament on Thursday, when other MPs were due to vote on what she brought back from Brussels. The only problem with that is that she's not brought anything back from Brussels. The conversations are still happening, and they're likely to be going on for another couple of weeks. So she's effectively pleading with Parliament today to give her these extra 2 weeks in order to bring something back from Brussels that she believes MPs will be able to get on board with. The only problem from an MP's perspective is that's 1 month before exit day, and there's no guarantee that she's going to get what she needs or wants. So there's still going to be a lot of scrutiny. The session on Thursday is still happening as far as I understand at this moment in time. At that point, MPs will have an opportunity to vote on amendments, non-binding in the main, if not entirely. So they are more indicative in terms of the votes, but they do effectively lay the groundwork for how MPs will likely press later on this month. We'll also hear from Mark Carney later on today. Again, it's probably likely to be a in large part a reiteration of what he said on Thursday. Now, the Bank of England on Thursday, in a way, cards close to the chest. There's not really too much they can say right now. The economic forecasts are based on a smooth Brexit transition, but there's so much uncertainty, both domestically and globally, due to the global economic prospects, the slowdown which we're seeing in a variety of countries, the changing dovish monetary policy stance of central banks. We did see a slightly more dovish Bank of England with regards to interest rates. I think a lot of people now are not expecting a rate hike this year. I'm not so sure, but I still think that if we do see that smooth Brexit transition, that we will see one rate hike, or could see one rate hike this year. The main reason being that the Bank of England's clearly still keen on tightening monetary policy, still sees interest rates as being too low, unemployment is very low, inflation is above target, and wage growth is above 3%. And I think Bank of England will look at this if we do get the smooth Brexit transition, and they will say, well, given all the factors, given the fact that we could, yes, growth is lower than we want it to be, and the global economy is looking a bit cloudy in itself, but we could get this post-Brexit boost. All of this delayed investment from businesses because of the uncertainty. Once that uncertainty is cleared up, will they start to invest money again and give the economy a little shot in the arm? Consumers who are holding back on spending in the run-up to Christmas and probably Brexit Day, is that going to give us a shot in the arm as well? Spending money because they feel like their prospects are less uncertain. And that may incentivize the Bank of England later on in the year, maybe August, November time, to raise interest rates just once. Again, there's a lot of ifs and buts and maybes here. But I expect Mark Carney to really reiterate what we heard on Thursday and really stick to the it very much depends on Brexit line. Of course, we've still got plenty of Fed speakers throughout the week. The Fed, which has become far more dovish over the recent months. Again, markets I still think could be underpricing this year, but if the economy, global and domestic, performs badly in the first quarter and probably the second quarter, the first quarter is always a little bit weak, but in the second quarter as well, then perhaps the Fed could hold off on raising interest rates, and it has given itself, afforded itself the ability to do so because of past action against the backdrop of heavy criticism at times, to be fair to them. But I expect them to retain this same dovish message, this same pause, wait and see mentality, at least for the next couple of months. The RBNZ is likely to become the next central bank to really join that crowd. They've been on hold for some time, and they're expected to remain on hold for some time. But now people are increasingly pricing in a rate cut potentially for maybe even as early as this year, maybe next, because the inflation outlook is less bullish, because the growth prospects and the employment prospects are less bullish. Really very much in line with what we've seen everywhere else. The RBA as well has very much joined the crowd here. It seems like a rate cut may be more on the horizon, more so than a rate rise at this moment in time. So the RBNZ is very much expected to join the crowd here. We'll also get economic forecasts, which will support any changing monetary policy stance from the RBNZ. So that's one to keep an eye on there. Potentially a downside risk for the Kiwi dollar if we do see a very dovish message coming from the central bank there. Again, it's back to the UK with inflation data early in the morning on Wednesday. We've got US inflation data again in the afternoon. This feels less relevant in a time of economic uncertainty, if I'm perfectly honest. Yes, we could see it at target, and yes, that justifies the central bank potentially raising rates. But when the outlook is so clouded and we've seen such a shift already, I don't think a 0.1%, 0.2% increase in these CPI readings, even if they are already both above target, is going to actually make any difference. CPI in the UK actually at 1.9%, not really above target, just actually just shy. Same with the core reading, but if we do come in just above, sorry, the CPI is 2.1, expect to fall to 1.9. But even if it is just above, I don't expect that to make a huge difference. I don't think monetary policy makers are going to suddenly be like, well, actually, the economic outlook is uncertain and cloudy at best, but I still think we should raise interest rates because we're 0.1 above. So I think this may go under the radar a little bit, if I'm honest, and for good reason. We've got Chinese data, imports and export data again on Thursday. That's really more of a point of interest for traders than it is, I think, going to be something that's a big market mover. Obviously, the US-China trade war, people want to see, are looking for evidence that is taking its toll. We had the front running of exports from China just ahead of the tariffs being imposed. So the aftermath of the tariffs being imposed is likely to exacerbate the drop-off even further. You can see here, for example, Chinese exports are expected to decrease for a second month in January, for a second month from 4.4% decrease in December to and a 3.2%. Now that's obviously very different from the 15.6% we were seeing here in November of growth. Clearly an indication that it is taking its toll. We are at the start of the year now, so the next couple of months of data is going to be a bit clouded again because timing of the Chinese New Year, this will always have an impact on activity there as well. So something to be aware of, but I do think there is certainly going to be an impact, a trade war impact there, and people are going to look for how severe that is and what kind of impact that could have on Chinese growth for the first quarter and just how damaging that's going to be. More and more we are seeing growth forecasts being revised down for China towards the kind of 6% levels for this year. Got GDP data for Germany and the Eurozone. Again, Germany, one that's kind of fallen off the radar recently, but as you can see here, Germany contracted in the third quarter by 0.2%. We're expecting it to eke out 0.1% growth in the fourth quarter. If that's a negative number here, Germany could be following Italy into recession, and that is huge. Now, we know that there are temporary factors which have contributed to that. One of that is, of course, the diesel emission testing, which has caused bottlenecks in factories and really slowed down the production stage there. And it's obviously a major car manufacturer, and it's a major industry in Germany, and that's had a negative implications for growth. The slowdown in China, obviously, it's a major trading partner for Germany, is having major implications as well. And there are other temporary factors contributing. But people are really looking at this now saying, well, this was meant to be temporary back in October. This was meant to be temporary back in September. This was meant to be temporary back in November. We're now in February, and we're still seeing these negative readings. We're seeing industrial production figures, which are dire. We're seeing PMIs, which are dire. This is looking more and more like it's going to be less of a temporary issue and could be indicative of a much slower year for the euro area as a whole. Of course, countries like Spain are seeing much better growth figures, but ultimately Germany, France, they're the real engines of growth. France is doing okay right now, but they have their issues of their own, of course. The yellow vest movement, protests against Emmanuel Macron very specifically and his regime has caused major disruptions there and has weighed on economic activity as well. US retail sales again are very closely followed. The US consumer makes up a considerable portion of the US economy, and therefore retail sales are always seen as a very good barometer for economic activity in the US. Another a weaker month expected for December, heading into a year which again is going to be challenging. I'm not sure we can read too much into the December figures, if I'm perfectly honest. I still think that the fourth quarter overall is still going to be relatively strong for the US, but it's this year where people are really going to be paying very close attention. The tax reform measures, the economic boost from that wearing off, people more and more forecasting negative earnings growth from a corporate perspective in the first quarter, pricing in increased potential for an earnings recession, 2 consecutive quarters of negative earnings growth. This, if it starts to materialize and if those lower growth figures start to become a reality, will ultimately have an impact on the consumer as well, and therefore weigh on economic activity. Like I say, I think this first quarter has a lot of questions to answer, and people are either going to be coming out of it feeling far more bullish and far more optimistic if the global economy really weathers the storm of this first quarter, or it could almost compound fears and really weigh on economic activity for the second quarter as well. Probably one of the reasons why I think Trump and Xi, President Xi, want to wrap up an agreement, remove a major source of uncertainty from the global economy, and remove a significant weight around the neck in many ways, because both economies potentially stand to suffer. And I think we know that Trump pays very close attention to stock markets. We know that he pays very close attention to the economic data. And if we start to see this really have an impact there, then the more pressure we see there, the more pressure there is going to be on him, and the more I think we are likely to see a deal. He's been given a good year of freedom in many cases to pursue this very hawkish strategy, because the economic figures have been so good, because the markets have performed so well on the back of these tax reforms. Well, the clock's now ticking, and the data is going to start being more and more impacted. So I do think we are going to see, at the very least, an extension to this 90-day period. I think more tariffs at this point could be quite damaging, and I think it's something that both sides will desperately want to avoid. And then we wrap things up on Friday with inflation data from China, retail sales data from the UK for January, and again another good indicator following that quite poor UK GDP figure. So with all that in mind, let's take a look at some charts. Now, what you're going to see in all of these charts is they've all got one thing in common. That dollar rally has been strong. It's been long lasting. We're now 8 days into a rally in the US dollar index. We're looking that we could potentially record a 9th today. And that has been the dominant factor across many of these currency pairs. Now, for those of you who've been joining for weeks will know that I've said for a long time, I still think longer term, I still think the dollar has more downside. Now, right now, looking at the charts, it's hard to really, you may be hearing that thinking that seems completely ridiculous. But I do think the trade talks with China primarily reportedly going less well over the last week or so has been a major contributing factor to the rebound in the US dollar. Monetary policy hasn't become more hawkish. The economy isn't performing any better than we were expecting before. The economic prospects outside the US have arguably deteriorated, which may have exacerbated the gains in the dollar. But I do think there is a keen eye on these trade talks. And as we saw during the escalation of the trade war when tariffs were being imposed, the US dollar was by far and away the outperformer, because people were looking at, for example, the dollar yuan, and they were viewing that the Chinese economy stood to fare worse than the US economy did in this trade war, obviously because the US economy is the country running the biggest trade deficit of the two. And we were seeing this play out, and we were seeing risk aversion on the back of this, which very much benefited the US dollar. When we start to see these relations improve, and post the G20 in December, really, and we start to see positive comments coming from the negotiations, we start to see the dollar pair off, reverse these gains. Now that we're seeing some more negative comments, it seems to be very much benefiting the dollar in the near term. But again, I do believe that we are going to see at the very least an extension to the truce between the two countries, which is due to expire on the 1st of March. And if we do see that, then I think we could potentially see that weakness in the US dollar resume. But again, this is me saying this after 8 days of gains and potentially heading for a 9th. So I really do believe the weakness in the euro as well has exacerbated this. We have to remember that the euro makes up, I think, around a half of the US dollar basket. So any weakness that we see in the euro and any weakness that we therefore see in the euro-dollar pair does have significant implications for the US dollar index as well. And the data we've had from the euro really has been quite poor recently. We've had obviously more dovish commentary coming from the central bank as well. What this means for the pair is that we're back at these lows around 113. And we do have this kind of longer term corridor here that you can see around these kind of 113 levels, just above and below. again, I typically don't try to use single lines. I do think the term like support and resistance is sometimes taken far too specifically. People looking for very specific levels of support and resistance. I tend to look for areas of support and resistance. I find it to be much more relevant for me, and it tends to really grasp everything a lot better. So I've highlighted this area here around 126, so 112.70, 113.10-ish, basically encapsulating a kind of 113 level. Even if we go below here, I'm not too concerned. That 112 we have come down to before. So if we do come down here, it will suggest to me that the market has weakened, and I do think this was a blip below, but I think I'm eyeing this area far more notably. If we get down here though, I mean, I won't be losing my head. But at the moment, we are finding support around this longer term support level, support and resistance zone. Momentum is naturally very much with the bears right now, but we're right at the bottom end of this channel. If we break below here, this starts to look far more bearish indeed, and I think I'm just going to have to, in the near term, give up my bearish bias on the US dollar, because I think that would send a strong signal. It would send a strong signal of bearishness for the euro primarily, but that would naturally, as I've just said, be a supportive factor for the US dollar. But I'll be very intrigued to see how we respond here over the next few days. It wouldn't surprise me if we initially saw some profit taking, and then it's about how the market really responds to that. We are very much at the trend low levels here, and we're talking long-term trend low, ignoring this one blip. And I know you shouldn't necessarily ignore it, but we're talking trend low since July 2017. And we've rebounded from these lows on numerous occasions in that time. If we're breaking through there, we're sending a very bearish message. We're seeing a very bearish message play out. And so doing so at the very first time we're asking after an 8-day rally seems a bit strong for me. But again, what kind of a message does that therefore send if it does happen? Cable, we've also seen some weakness, and again, this has benefited the dollar. Again, I do think this is primarily a dollar move, but when you're looking at some of these charts, it's easy to understand why it's kind of a two-way thing. Now, these things are always two-way on the pairs, but the fact that other currencies, so many other currencies, are seeing weakness at the same time does just exacerbate those moves, and maybe explains why we're seeing an 8-day rally rather than a 2 or a 3-day rally in the greenback. We've seen profit taken in the pound basically ever since Theresa May last went to Parliament, and they backed her to go back to Brussels and seek changes on the backstop, try and get that changed to alternative arrangements, whatever the hell that is. And since then, we've seen some profit taken. Traders were very bullish on the pound at this stage, and I don't really think that's changed. People keep talking about the potential that we've seen a bullish shift. In fact, the potential that we've seen a shift in people's no deal expectations. I do not think for a second that we have. We have seen some economic data weakness, which I do think has exacerbated the move, because we were really consolidating in these levels prior to the data. Some of the data we've had recently, and the dovish Bank of England has further exacerbated those moves. But we've still only seen a 50% retracement from the lows to the highs. So I don't think anything has fundamentally changed. And even then, we're seeing some support here. We are looking at the momentum at the moment. We're not necessarily seeing a momentum shift on the daily chart right now. Looking at the 4-hour chart, I think we are. So around that 50 fib, we are seeing the stochastic kind of flat line. We're seeing the moving average histogram start to show some divergences. The moving averages on the actual histogram itself are starting to show some divergences. I do wonder whether we are seeing a strong reluctance on sterling bulls to let go of this. Sterling bulls who effectively, in my view, and I think there is a general market perception here that we are going to see a deal. And sometimes it's just a matter of patience. And at some point, traders' patience will always wear thin. The longer this goes on, the bigger the risk, downside risk becomes. And I'm still seeing resilience at this moment in time. At some point, the longer this goes on, the more this may break, especially if traders decide that this could be a minute to midnight deal. And at the moment, midnight is the end of March. So they may be viewing this and going, Joe, we're not going to see a deal in the next few days. We're not going to see a deal in the next 2 weeks. I'll wait. And we may see that build up. But at this moment in time, I'm still seeing a resilience here. And we're holding up on the 50 fib at this moment in time. So these are the levels I'm really keeping a very close eye on. ultimately, I'm looking at this kind of just below 127 area. This has been long-term support. Again, we had this little blip. If we see a break through here, then it would suggest the market's definitely become more bearish. The 50 and 61.8, etc. I think are very notable. Longer term, like I say, I still remain bullish on that, but in the near term, that could very much pose a threat. Euro sterling, we're very much seeing in the near term two weaker currencies playing off against each other. At the moment, it's benefiting the euro, but that's purely because the move we saw prior to this was quite an extreme one on the sterling perspective, going right from the range high right to the range lows. We did see profit taking come at these range lows again, as we did see in pound dollar. And since then, we've seen a bit of a corrective move again back to the 50 fib. For me, the key levels here is the 50 and 61.8 fib. We've got a consolidation of moving averages there as well. It seems that you were seeing like the kind of break above the moving averages and then back to the highs. We see the break below the moving averages and back to the lows. So this kind of marks, this kind of area between the 50 and 61.8 fib for me marks the bullish kind of bearish divide in many ways. If we see a break back above there, it would suggest that people are kind of giving up on the bullish sterling bias. Whereas a rotation off here suggests that it still remains strong, and especially coming up against a weaker euro. If you're seeing a weaker euro breaking through key resistance levels against anything, it doesn't really send a powerful message about that alternative, the opposite currency. And now we're getting to the frustrating currencies, the antipodeans as they're known, the Australian dollar and Kiwi dollar, because these are ones which technically have looked desperate to break higher, and I do think the weaker dollar has been a primary driver of that. But what's happened recently between the dollar rebound for the last 8 days and now the dovish central banks and the RBNZ likely to join tomorrow and the RBA joining also becoming more dovish, it's just taken so much of the air out of it, out of this move. So once again, we saw a breakthrough this falling channel, and it looked as though we could take off to the upside, and we've rotated off this 200-day simple moving average and back to the downside. We're back at the kind of long-term support here, long-term support zone around 70.20 through 70.85, call it 73.71 if you will. At the moment, we're finding support, but if this breaks, then for me, I think that's a very weak signal if we see a breakthrough this zone, because we've only broken below one here at once here, and that was on the flash move, the flash crash in the Aussie dollar, which came at the same time as the flash spike in the Japanese yen, the safe haven yen. If we break through here when we're not in the midst of a flash move, that suggests that there's just general weakness that's continuing to materialize in this pair, and the hope for me, therefore, of a break then higher, not necessarily falls apart, but it just very much gets delayed until we start to see dollar weakness forming again, and that will be the primary driver of any rally here. But the moving average bands really are playing a strong role here for me, and we are seeing again the rotation off there. If we break through, then for me that's a very bullish signal. But right now, it looks like we're just going to have to sit and wait. I'm going to come back to the Canadian dollar in a second, because I did talk about Aussie and Kiwi being closely linked. And you'll remember that when I was initially talking about the falling channel, the initial falling channel and the breakout that we saw, the move in the Kiwi dollar higher was more extreme than the Aussie dollar. We hit big levels in the Kiwi that we didn't reach fully in the Australian dollar. And then we had a bit of a corrective mode beyond the 61.8 fib here, but then we started to move high. We broke through the 233-day simple moving average band once again. We've kind of held above the 55.89, but we're seeing the crossover here. And I'm very keen to see what materializes here, because the thing that worries me is we failed to make a new high previously, and we held on the 50 fib. So that's potentially a bearish signal forming here. We've come back to the 233-day simple moving average band, and we're trading back below. We're pushing the low end of the 55.89 as well, and we're threatening to make a new low. So a failure to make a new high, I'm making a new low. I feel like the bearish signals, the bearish flags are just popping up right, left, and centre here. And I think the RBNZ could really finish that off tonight if it comes out with a dovish message. I guess we'll have to wait and see. I was really liking the look of this previously, and I'm talking back at the November, December time. I thought this was looking really nicely bullish and really feeding into the weak US dollar story. But that is the market. Dollar CAD on the other hand, again, the move is delayed. The US dollar really almost spoiling the party here, because we look as though we could potentially be looking at a break below this rising channel, this long-term rising channel. I was talking at the time about how 130 is just as key, really, because the breakthrough here is a nice strong signal, but 130 I'd like to see broken as well. We've seen it move out of this kind of range before a couple of times, and it's been a false breakout, so I'd like to see 130 go as well. But it would start to look hopeful when you're taking out big fib levels, you're taking out big moving averages, you're taking out channel lows. If you take out a psychological level as well, then it just reconfirms in many ways what the kind of bearishness of what you're seeing playing out. That's been delayed with a bounce in the US dollar, and we've also seen a stall in the rally in oil as well, and the correlation between the Canadian dollar and oil is obviously known. So what we've kind of seen here is just this bounce back. But what I'm encouraged by is the fact that we've not broken back above the 55.89 moving average bands at this moment in time. We are seeing a down day today. We've not broken through that previous high, and the 38.2 fib has offered some resistance. We've just had the release of the OPEC monthly report for oil, and just seeing a couple of notes which have been sent over now. OPEC sees weaker demand for its crude as US supply thrives. And for 2019, oil demand growth is forecasted around 1.24 million barrels per day, slightly lower than the previous month's assessment by 0.05 million barrels a day, to reach 100 million barrels a day. The downward revision is mainly due to lower economic expectations for 2019 for the Americas and Europe, as well as Latin America and the Middle East. That looks quite dovish for me. That looks quite negative from an oil perspective. If you're talking about surging supply, lower demand growth, lower economic growth risks around the globe there, that seems like a bearish story for me. We can probably bring up an oil chart actually just to see how that looks live on the oil prices. And you can see here we've got the WTI. We seem to be holding up, which is quite interesting. Yeah, we've seen a little pop higher, not too much really. I thought that the OPEC report may have had a greater impact here, but we're kind of holding up there. So we're coming off the lows, obviously. I still think this looks potentially bullish. I think we're waiting for catalysts here on oil, and that, as I said earlier, does have implications for the Canadian dollar chart. But oil's holding up, and that's why we're seeing the dollar pairing its losses today being exacerbated by the Canadian gains here. Like I say, there's even potential for an inverse head and shoulders be forming here, but we're failing at the highs here, so there's still potential for a bearish move. But as with everything, it seems we're in wait and see mode in terms of when that actually plays out and the dollar continue to frustrate. Channel longer term, we are edging lower. This weakness in the pound, and we're seeing relative strength in the Canadian dollar still, but this is so Brexit dependent. We could be quite easily move back towards these 169s, back down to the bottom of the range, but I still think there's a reluctance, there's still a resilience I still feel in the pound that will stop too much of a significant downside unless we see a significant deterioration there. If we see a break below this range, then that 166 becomes very notable for me. But whether, I think you need to see one or two things there. You need to see a collapse or relative collapse in the talks, or a significant backstep in the talks on Brexit, no deal becoming far more of a possibility, or you need to see a strong rally in oil to support that move. Finally, we'll wrap things up with the yen pairs, and we're hitting some really interesting levels here. Now, we've broken through the Ichimoku cloud here. Not convincingly, I must say. We've kind of sidestepped our way through, and you'll see on the euro and sterling charts as well, that's very much the case. But we're hitting these 111 levels, 111.50s, and I think this is really interesting because 111.50 has previously been a notable area of support and resistance, most recently here and support back here. But we've also got the culmination of these two moving averages around 111, 55.89, 200, 233. We yet see obviously we're still far away from potential confirmation from the lagging line breaking through. If we see a rotation off of these levels and we remain in this rising channel, then potentially some bearish signs. It would potentially suggest that we're seeing the kind of dollar peak, and some profit taking in the US dollar wouldn't necessarily surprise me. Yen dollar not performed quite as well against the yen as it has the other pairs, which again another reason why I do think the euro and pound have played a big role, and the stalling oil prices with the Canadian dollar played a big role in the dollar's gains over the last 8 days. But we're clearly starting to see some profit taking in the US dollar here, right around this key resistance level. If we rotate lower and through that channel, then that would suggest to me that we're potentially seeing a false break through this Ichimoku cloud, but one to keep an eye on again. Sterling yen and euro yen, I'm less convinced by, because we've not even risen through the cloud. We've kind of stumbled sideways and downwards and across it. Now, the pound, of course, could have a very strong bullish catalyst over the next couple of weeks, which really takes it through and gives you a much more convincing kick. And again, that reluctance, downside reluctance in the pound is very evident here as well. We're kind of sitting on the 55, on the 55-day simple moving average here. We're testing below, but we're kind of holding at this moment in time. Again, longer term, I'm still bullish the pound. I just think we could potentially see some more consolidation, Brexit frustration in the near term, just dragging a little bit on the pound. But if we see a break higher, then obviously we start to look at these kind of 144s to 144.50 zone, 155 for it being the next test here, and that's where you get the 200 to 233-day simple moving average come into play. And then for confirmation of the break through the Ichimoku, you'd be looking for a break through these kind of 146s with the lagging line having to go through there. And again, that provides that kind of confirmation that you're looking for when you're looking at Ichimoku. The euro was very much similar in both cases. We're kind of fallen through the cloud, fallen up through the cloud, which seems counterintuitive, but that's very much what we've seen. I still think the euro looks weak. And that's obviously evident by the fact that we are testing the bottom of this rising channel here. We have gone through the cloud, but it really wouldn't surprise me if that doesn't hold. I really want to see a good uplift in this before I start to become any more bullish, and I just don't think the catalyst is going to be there in the near term. But again, we'll see. There's two sides to this currency, and the yen is a safe haven currency. It's got a central bank which isn't really doing anything right now. And if we see a bullish return of risk appetite for whatever reason, then that could work against the yen, and that could give us that little bullish boost. But I think we'd need to see, to get some real strong, significant upside, I think we'd need to see an improvement in the economic data. And in the near term, that just really doesn't look likely, unfortunately. So my bias still remains bearish on this. And I think, from my perspective, regardless of the cloud move, I feel like we're more likely to see a break below this rising channel than we are got to see a break above it. But let's just wait and see how that materializes as well. Okay, that's all we got time for today. Thank you everyone for joining. I hope you found that interesting. I haven't got any questions, so hopefully that means I've answered everything, although it probably just means that you'll think of questions later on. And if you do, reach out to me on Twitter. I'm always happy to chat, help, catch up, anything. It's Craig_Forex. And apart from that, please do join us again next week for another webinar, same time next Tuesday. And check out everything else that we have on offer. OANDA Market Pulse, which is marketpulse.com. Check out OANDA Market Insights, the podcast, released every Friday, and OANDA Market Beats podcast, and I believe that's released every Wednesday. The recording of this will be found on YouTube in a few hours' time. You'll also find it on Market Pulse, and I'll also tweet it out as well. But apart from that, have a fantastic week. I wish you all the very best of luck with your trading. I'll hopefully see you again soon. Thank you very much.